Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. Today, I want to give you a tip that you definitely want to implement into your investing strategy. It's something that can help you to both increase your performance, but also kind of protect against some losses. So I'm gonna be transparent as always, but give you some actual numbers I have in my public portfolio and why I invest this way and why I'm not panicking. Because if you are investing for the first time right now, with the exception of today, it's been rough the last 2 weeks. It was real rough in September, October-ish, and things have been very, very choppy. And that's when people get worried. That's when people say, I've only been doing this for 3 weeks, but I'm still afraid I'm losing money. Is this normal? What should I do? So what I do and what I tell my students and what I've told clients is you want to be diversified. I say that all the time, but specifically I talk about what I call the 5% rule, which means that I don't want to have more than 5% in any one stock starting off. And this is in the context of someone who's only investing in individual stocks. Now, if I have an index fund, something like SPY, VOO, VTI, things like that, you have as much as you want there. It's already diversified by itself. But outside of that, right? Outside of that, let's say I'm looking at PayPal, Costco, Disney. I'm just thinking of whatever comes to my head. How much money should I put into those? And for me, that number is 5% as a max. Now, every year or every 6 months, which is what I do when you guys see me selling, I start to kind of chop off and even things out so that I'm balanced. And the reason why you want to be balanced is because you are not going to be perfect. I am not perfect. And there have been times where I am extremely right when we talk about sometimes retail stocks or Costco or something like that, and boom, we're up 30, 40, 50% over a period of time. That's great. When we talked about Avis, got up here, was talking mad noise, and that was great. But I ain't perfect, right? Not perfect at all. But the thing that protects me from severe losses is this 5% rule. So for example, and I wrote some of the notes down, just took my highest and lowest performance in my public portfolio right now. I was pretty high on Disney. I wasn't the most confident in the world, but I was pretty high on Disney. It's down 17% since I've had it. Okay. That's the reality right now. Square, yeah, I talked a lot about Square, and at one point this year, I was up 30 to 35%. Square and PayPal and Affirm and Visa, a lot of these payment stocks, for whatever reason, I'm going to do a video on it when I dig in and find the answer. But a lot of those are absolutely trash right now, and I'm down 21% there. Now, if all of my money was in Disney, and there's a case where I could be confident in Disney. There are people who are very confident in Disney. There are people who are super confident in Square, which is now renamed Block. Had I done that, I would have been hurting right now, down 21% in Square/Block and 17% into Disney. That's not good, right? Which is why I diversify and I have multiple companies, and those are just two bad ones. Other companies I invest in that are doing well: 46% gain in Apple, 52% gain in Google, and 34% gain in Ford. This is why things can, you can be down in some cases and you can afford to be wrong because you have several companies that we think are quality going into it. You can go back and watch those videos. I'll leave them all up there. And the case for Square and PayPal, for that matter, are still there. I don't know. I cannot tell you why they're down at this point in time, because with inflation, if what I bought was $100, price goes up to 105 now, and I'm still charging the same percentage. If I'm Square or PayPal, I should be getting paid more money. I logically do not understand why they're not doing well. However, right? Hey, we're wrong on that one. End of this year, we sell out of it, move into something else. Totally fine. But it's only because I'm diversified is why I can take that loss and be okay, right? And not panic. Overall, my total portfolio is up close to 20%, which is not beating the market, which is what I would prefer to do. But honestly, that is very hard to do on a consistent basis. But that's fine. Hey, we were wrong. We were really wrong on Square. The market didn't like it, and that's fine, right? I don't need to panic. I don't need to, doubt everything about life, but it is okay when you are diversified. If you only have 2 or 3 or 4 stocks and they're not doing well, or one of them doesn't do well, then this weights this weighs more heavily on you, which is why you want to be very careful and why you want to do those things. So again, my rule is 5%. That means that you can own up to 20 stocks, assuming it's 5% max for each and every one of them. You can obviously have 1%, you can have 3%, whatever it is that is most comfortable for you. Most textbooks, I've said this before, are going to say anywhere between 20 to 30 stocks is what you need to be quote unquote diversified. I think I have 14 or 15 on public now. Will I add more? We'll see, but I have an index fund there, so that's going to kind of adjust the numbers just a bit. But the point of having multiple companies is to make sure that you are putting your money in different places in case things don't turn out the way that you want to. The other thing too, if you're an individual investor, you are not doing this kind of stuff full time, and you don't have, formal training or degree or anything like that, you don't have to. You don't have to do that. You never hear me say that. However, if you've got like 25, 30 on your own, that's doing a little too much because of the level of detail that's going to take you to really understand each and every one of those companies. And unless you got time to be reading and researching 30 different companies and know what's going on at all times, not all times, but know what's going on, the ins and outs, then, I think starting off 10 to 15 makes sense. If you get to 20, I think you're probably okay there. Once you start to get to 25 and more, it's going to get a little cumbersome to make sure that everything is balanced. It's going to get hard to understand how each of them are going to be impacted by market conditions and things like that. And that's just that's the realistic view, which is why I got it at 14, because I can memorize that. I know what's going on. I know how to move, what stocks to buy and sell, because that's a relatively manageable list. However, I am taking more risk, right? So it's always about that risk versus reward, but you do want to be careful. The last thing I'll say, and I've seen this happen, especially for new investors, which is the great thing about public, because I can go and see what you're investing in, because people ask me like, hey, what do you think about this? What do you think about this? Or I just started investing. I'll click on the profile and say, I don't know about these stocks. Always take the time to understand what you're investing in and understand what that case is supposed to be, right? Even though we were wrong, and you can be wrong, even though we were wrong about Square, the case was people were spending online. The stock was going crazy that year. I think last year it was up 100 and some odd percent. We're thinking, hey, we're half wrong. We're up 50. It looked fine up until September or so, and it didn't pan out. And that's fine. You have multiple stocks, but you have to know, what did this company do? Why are they doing it? And what is the case for them to continue? We talked about that with Square. We talked about that with the metaverse stocks. Anytime I talk to you guys about a stock, it's this is what it's doing. Here's the case for it to continue to grow, and my decision on whether or not to invest. If you don't have those things, you don't want to invest in it. I see a lot of people investing in a lot of random things, and if you know about it, fine. But if you don't, when times like this, or times like yesterday, or times like the last 2 weeks, you're going to get confused, you're going to get frustrated, and you're not going to know what is the best move for you. And I want to protect you against that. How do you protect against that? Again, number one, the 5% rule. Stick to that or under to make sure you're having enough diversification, and then two, understanding exactly what you have and understanding what is the case moving forward. Those things are going to make you a better investor. It's going to help you to remain calm in times like this, because I'm telling you now, if all I had was Square and I put everything on Square right now, I don't know if I would be calm. I don't know. If I put everything in Disney, I don't know if I would be calm. I don't know. And there are days, today was not one of those, but there are days where I look and everything is red. That's fine. That's fine. I'm investing for more of a long-term growth status anyway. But I also know that, hey, Square can be wrong. Disney can be wrong. Capital One can be halfway wrong. That's fine, because I've got X, Y, and Z companies propping me up and balancing things out. To have a company that's down 21% and 17% and still be up 20% is still good. If I just left these two companies alone, there's no telling where I'd be. But that's fine. It's one sample size. You look at it, you deal with it, you move on, and you improve. And that's how that process works. So just wanted to let you, get background into what is going on in my portfolio, and give you the thought process and the processing that you don't have to panic. You don't have to put pressure on yourself to be perfect. If you made money, you're good, right? You don't go broke taking a profit. I would have preferred to have more. I would have preferred to be in that 30% range, considering that the market is at like 25 or so. But I'm not perfect. You're not going to be perfect, and that's totally fine. So again, stick to that 5% rule or whatever rule works most for you. But do know that you don't want to put your money all in one basket. There's a sweet spot between having way too many companies that you can't research and you're only putting $2 in. That's not going to really help you. And then there's a bad spot where you only got 3 to 4 and one thing goes wrong and the entire portfolio is at risk. So find that sweet spot for you. For me, I think, anywhere between 15 to 20 makes sense. 10 to 15 if you're new. Start there. Really start to understand those and hone in that process and start growing from there. All right, that is it for me. I got some other really interesting topics to talk about. I had some great submissions in the comment section on YouTube. You got more questions, feel free to put those in the comments as well. And we'll keep this going until the 21st when I get back home and have my normal setup. But again, my job is to teach y'all. I enjoy doing it and I love answering questions, so feel free to do that. Also, make sure that you hit the link that usually appears down here somewhere about the email list. You want to make sure you're on there. I send out goodies and information every now and then, as well as free classes and info. All right, that's it for me. Talk to you guys later. Bye.